At 48, Elena has two versions of the same career. Inside her employer's systems, she has documented results. $38,400 in duplicate vendor charges recovered. A monthly close shortened from 9 business days to 6. A reconciliation backlog reduced from 126 items to 18. And 3 colleagues trained on the new process. On her resume, the same work becomes 5 words. Responsible for monthly close. The value did not disappear. The evidence stopped traveling. That is the employee problem this video will solve. Not the existence of a salary, not the existence of an employer, and not the idea that every skilled employee should quit and start a business. This is about a system that stores valuable work inside internal language, delays outside price signals, and leaves the cost of changing jobs on separate pages. That mechanism has a name: the transferability tax. It is not a government levy. It is not the difference between company revenue and Elena's salary. Company revenue divided by employee hours does not reveal Elena's individual value, the employer's profit on her work, or a fair wage. Revenue also pays for materials, equipment, facilities, software, insurance, debt, taxes, other workers, risk, and many costs Elena does not control. The transferability tax is narrower. It is the option cost created when Elena cannot safely carry verified proof, a current market signal, and a price transition from one employer context to another. Elena is a fictional composite. She is 48 and works as a senior staff accountant at a regional manufacturer in Indianapolis. She has 19 years to age 67. Her gross pay is $82,000 per year. Her model take-home is $5,050 per month after payroll deductions, her employee health premium, and her current retirement contribution. Her tracked monthly outflow is $4,650. That includes a scheduled $350 card payment and her required student loan payment. Her current monthly margin is $400. She has $9,000 in cash, $64,000 in retirement savings, $7,800 on a card charging 23.99%, and $22,000 in student loans at 6.2%. She currently contributes $400 per month to retirement. Her narrow-tracked position is $43,200, $9,000 cash, plus $64,000 retirement, minus $7,800 car debt, minus $22,000 student debt. That is not her complete net worth. It excludes her vehicle, personal property, other accounts, taxes, insurance value, and every unlisted obligation. The take-home number is a model, not a tax calculation for another worker. Employment is not the antagonist. Her employer is not the antagonist. Elena's age, salary, and decision to stay are not the antagonist. The antagonist is an information architecture with 3 gaps. The first is the proof ownership gap. Elena's work lives in meeting notes, internal dashboards, accounting systems, and the memory of managers. Her job description records duties. Her performance review uses broad ratings. Her resume repeats the job description. What does not travel is the verified change between before and after. This creates 2 dangers. If Elena says too little, the work becomes generic. If she takes confidential files, customer information, proprietary reports, or personal data, she crosses a boundary she must not cross. The answer is not to copy company records. It is to build a safe, authorized evidence trail while the work is still fresh. The second mechanism is the market signal delay. Elena's annual review tells her how one employer evaluates her within one compensation system. A national wage median describes a broad occupation. A recruiter conversation is a signal. A job posting is an advertised range under stated conditions. None is Elena's personal market price. The Bureau of Labor Statistics and ONET describe accounting duties, skills, wage distributions, and labor market context. Those sources are useful for vocabulary in a broad comparison. They do not prove that Elena deserves a specific salary in Indianapolis. The strongest current price signal is a written offer for a defined role, location, schedule, and benefit package. Until that exists, a salary target remains a hypothesis. The third mechanism is exit cost fog. A higher salary can look obvious while health premiums, deductibles, provider networks, retirement vesting, employer contributions, waiting periods, commute, paid leave, and transition cash remain unpriced. One page says $96,000. Another page says health coverage starts later. A third page hides the retirement contribution Elena could lose in year 1. The decision feels emotional because the comparison is incomplete. Now comes the turn. In the 1999 Berkshire shareholder letter, Warren Buffett and Charlie Munger described a strength they recognized when they were operating inside their circle of competence and when they were approaching its perimeter. They did not substitute hope for rationality outside that boundary. That letter is about investing and business evaluation. It is not a command for Elena to leave employment. The useful principle is an evidence boundary. Know what you can demonstrate. Know what remains outside your evidence. Then make the option compete on documented terms. The first blocker is the portable value file. Elena creates one entry for each material result. Every entry has 5 fields: the starting condition, the action she personally owned, the documented outcome, the skill that transfers, and the safe evidence source. Her first entry records $38,400 in duplicate vendor charges recovered through a redesigned review. The transferable skills are data analysis, control testing, exception review, and written communication. Her second entry records monthly close moving from 9 business days to 6. The skills are process mapping, deadline coordination, and workflow improvement. Her third entry records the reconciliation backlog moving from 126 items to 18. The skills are prioritization, root cause analysis, and follow-through. Her fourth entry records 3 colleagues trained. The skills are documentation, coaching, and process adoption. Elena does not claim that she alone created all company value connected to those outcomes. She does not take confidential files. She uses approved, aggregated facts and removes customer, employee, vendor, and proprietary details. If an outcome cannot be documented safely, she describes the skill without inventing a number. The portable value file blocks the proof ownership gap because her work no longer collapses into a list of duties. The second blocker is the offer test ladder. Elena begins with official role language. ONET lists tasks such as analyzing data, reporting findings, and recommending changes. The Bureau of Labor Statistics provides national and area wage tools. That is the context layer. Next comes the conversation layer. Elena asks 3 people who hire or supervise accountants which outcomes matter in the roles she is considering. Then comes the application layer. She submits 6 tailored applications using only roles that match her skills, schedule requirements, and geographic boundary. 6 applications are not a universal formula. They are Elena's small test. In this fictional story, 6 applications produce 3 interviews and 1 written offer. The offer is $96,000 per year. That does not prove every employer will pay $96,000. It does not prove Elena is underpaid. It proves one employer offered one amount for one defined package at one moment. Her current salary is $82,000. The gross salary difference is $14,000 per year. Now she has a real signal to compare, negotiate, accept, or decline. The offer test ladder blocks market signal delay because broad opinions end in written evidence. The third blocker is the transition price map. Elena opens the actual documents for both packages. Her current employee health premium is $310 per month. The written offer lists $440 per month. The difference is $130 per month, or $1,560 per year. Her current individual benefit statement shows a verified employer retirement contribution of $3,280 per year. The new plan documents show no employer retirement contribution during the first 12 months. So the known first-year package comparison begins with a $14,000 gross salary difference. Subtract $1,560 in additional employee health premiums. Subtract $3,280 in foregone employer retirement contributions during year 1. The remaining known difference is $9,160. That is before taxes and out-of-pocket healthcare costs. It is not take-home pay. Elena does not automatically subtract the difference between a $2,000 deductible and a $3,200 deductible. A deductible is a threshold, not a bill guaranteed to be spent. She separately compares provider networks, coinsurance, out-of-pocket limits, prescriptions, paid leave, work schedule, commute, and any coverage waiting period. The United States Department of Labor tells workers changing jobs to compare health plans, premiums, coverage, doctors, waiting periods, vesting, and retirement plan documents. The summary plan description and individual benefit statement show what Elena has actually earned and what remains subject to plan rules. Healthcare.gov says losing job-based coverage can create a special enrollment period, but price and savings depend on household facts and the application. COBRA may be another temporary option under its own terms and full premium. Elena prices those options before resigning. The transition price map does not tell her to accept. It turns one salary headline into a decision file. The file also includes Elena's financial runway. She keeps $7,000 of her cash as a personal transition reserve. She applies $2,000 to the high-interest card. Cash becomes $7,000. The card becomes $5,900. Her narrow-tracked position remains $43,200. Moving cash to debt does not create wealth. It changes liquidity and interest exposure. Elena combines the scheduled $350 card payment with her $400 monthly margin. The modeled payment becomes $750 per month. The assumptions are no new charges, a constant 23.99% annual percentage rate, monthly compounding, month-end payments, and no added fees. Actual issuers may calculate interest daily, so Elena uses her statement for a real payoff date. Under the simplified assumptions, the card reaches zero in month 9. The final modeled payment is about $365.30. Total modeled interest is about $565.30. That interest is not added to the salary difference or a future value scenario to invent a transferability tax total. At month 9, the $750 card route becomes available. Elena adds $400 to retirement, bringing total modeled retirement funding from $400 to $800 per month. She routes $200 to transition reserve growth, and she keeps $150 for planned flexibility. The released amount still totals $750. She must verify plan access, match, vesting, waiting periods, investment options, fees, eligibility, tax treatment, and contribution limits for whichever job she holds. Now test the 19-year runway to age 67. The Social Security Administration lists 67 as full retirement age for people born in 1960 or later. That is a planning marker, not a claiming recommendation or benefit estimate. Elena begins with $64,000 in retirement savings. The baseline contributes $400 per month for all 228 months. At a fixed 5% annual return with monthly compounding, the modeled balance becomes about $316,898. At a fixed 7%, it becomes about $430,754. The action path contributes $400 for 9 months, then $800 for the remaining 219 months. At 5%, the modeled balance becomes about $459,537. At 7%, it becomes about $607,282. The modeled differences are about $142,639 at 5% and $176,528 at 7%. Those differences are not money currently missing from Elena's account. They are separate nominal fixed return illustrations before fees and taxes. Returns are not guaranteed. Contributions can be interrupted. Inflation changes purchasing power. The model does not include Social Security, salary changes, employer contributions, or a retirement spending target. It does not prove retirement adequacy. The relief is not that Elena escaped employment. The relief is that employment is no longer her only source of information about her own options. Her work has a safe evidence file. Her market hypothesis ends in a written offer. Her benefits and transition costs share one map. She can stay, negotiate, apply again, or move without pretending any choice is automatically correct. That is what blocks the transferability tax. If you are between 38 and 52, do not begin by dividing company revenue by employee hours. That number cannot price your individual contribution. Begin with one result you can document safely. Write the before condition. Write the action you owned. Write the measurable after condition. Translate it into portable skill. Then test a market in steps small enough that your current job, privacy, benefits, and financial runway remain protected. The goal is not to stop selling time. The goal is to stop letting the proof of your time disappear when the employer context changes. And in the next hidden tax, we will examine what happens when a financial milestone becomes permission to increase every cost around it.